Hi, everyone. This next panel is going to be on the truths of today's fundraising climate, which I know a lot of both founders and managers have had to navigate in interesting ways. And so today we're joined by three amazing panelists. We have Jennifer from January Ventures. We have Sofia from Bessemer and Trina from Intel Capital. And just to introduce myself, who'll be moderating, my name is Julia Krieger. I'm at Pari Passu Venture Partners, and we are a founder-led, founder-backed early-stage fund that invests at the intersection of tech and retail, and really looking forward to diving into some great questions today. Let's start off with all of the speakers giving a quick introduction on themselves and their background in the world of early stage investing. Jennifer, let's kick it off to you to start.
Sure. Thank you, Julia. It's great to be here, and I look forward to this discussion. It's certainly a very relevant and important topic right now. As Julia mentioned, I run a fund called January Ventures. I am based in Boston. My partner is based in London. We invest across the US and Europe. And we're pre-seed focused. The goal is really to fill the gap, the capital gap at the earliest stage, take an institutional approach, and democratize access to venture capital. Venture is, such a closed, narrow network that we founded January because we felt like so much value was being left on the table. Thematically, we're focused on B2B software that is bringing legacy industries up the digital curve. So think healthcare, climate, supply chain, work and productivity. I started my career as an operator, spent the first half of my career building businesses in the media, tech, and e-commerce worlds, and realized what I loved doing was working with founders at the earliest stage. And so that's what led me over to the investing side 10 years ago, first running an accelerator, and then now running January Ventures. So I look forward to the discussion today.
Thanks, Jen. Sofia, can you introduce yourself?
Hi, everyone. Nice to see you all, and Jen, Julia, and Trina, thanks for the time. I'm Sofia. I'm a VP at Bessemer. I'm also based in Boston, Jen. And I'm part of the healthcare and life sciences team at Bessemer. So I spend all of my time looking at the healthcare and bio industries and cover anything seed to growth as part of that team. Prior to joining Bessemer, I was doing seed investing at a fund out of New York called Box Group Ventures, where we did pre-seed and seed investing, and I also focus in healthcare and life sciences there. And I'm a scientist turned investor, studied chemistry in undergrad, and then went into consulting at Bain & Company, where I focused in healthcare. Had the pleasure of working there for 4 years with lots of different incumbents and in different industries, sub-industries of healthcare. So as you can tell, I've been very deep in the industry and really enjoy kind of thinking about new business models that can really change the status quo, how care is delivered and access in this country.
Wonderful. And Trina?
Hi, it's great to be here. So Trina Van Pelt, I'm a senior managing director of Intel Capital and VP at Intel. I lead our frontier domain, which is paradigm shifting deep technologies and digitally transformative intelligent edge. It's a very broad category, anything from edge infrastructure, sensors, vertical applications in robotics, autonomy, industrial, and healthcare. I spent the last 25 years in broad global corporate development as both an investor and an acquirer of software and hardware companies. Led about 90 deals, and the investments have been from single-digit millions to billions. Acquisitions also from sub 10 million to 17 billion, so a very kind of broad range of transactions. The last 5 years have been solely focused as a venture growth investor within Intel Capital. A little bit about Intel Capital. 30 years ago, we pioneered corporate investing. We put about 20 billion to work over that time. Global investor between the US, China, Europe, and Israel. We currently have about 5 billion assets under management, about 250 companies. We are balance sheet investors. We put to work about 300 to 500 million annually, and very thesis driven. So I covered frontier, but we also focus in cloud devices and silicon. We lead. We've been continuing to evolve Intel Capital to be more impactful and relevant. And we are financially motivated, but strategically relevant. We lead 75% of our deals, stage agnostic, but we index towards A and B, and are very active board members and seeking kind of value add beyond the capital.
Great. Well, I'm glad to see we're going to have so many different perspectives in terms of stage and sector. So I think it'll be a great conversation. Diving into it, there's no doubt, obviously, that the funding climate has changed. Everyone's felt it in different ways. So let's start by discussing the catalyst, right? Jennifer, let's start with you, and then Sofia and Trina after. What do you believe shifted this fundraising climate? What are you seeing now in comparison to 2021? Would love to hear your thoughts.
Yeah, so I think it's a sort of an understatement to say that the fundraising environment has shifted. It's something we're actually releasing our early stage founder sentiment report. And the data is really interesting just to see how founders' fundraising efforts have been impacted in the last year. Lots of founders are pausing and pushing out their raises, but I think a lot of it had to do with macroeconomic environment and the shift there. But certainly, if you asked about the sort of comparison to 21, and I think it's interesting to look at this even over the past 10 to 15 to 20 years. And I do believe that the reset that we're seeing, although, it happened quickly and has felt so jarring to many founders, it's a bit of a return to normalcy. And so what we saw in 2020 and 2021, and even in the few years leading up to the pandemic, was that as interest rates were at near zero, capital was flowing into venture like never before. The IPO market was very frothy. And so, valuation multiples were at peak highs. And when you look at that period in historical context, it's very clear that we were in this peak bubble, right? And so while it is painful for founders and investors who are living through it, I think we've sort of reset to normalcy and this return to diligence and true company building rather than building just to raise the next round. And also relationship building. I think those three things are good for investors and founders. And I'm happy to talk about why, because I think for some founders are like, oh, can't we just return to 2020 and 2021? So I think, that's sort of how we think about it. One of the things that is interesting, we sit at the earliest stage, and what we've seen is that, a lot of the news has covered the valuation decreases at the later stage. And Trina, I'm sure Trina and Sofia can speak to that. But what is really interesting is when you look by stage, seed valuations have actually held steady to increase depending on which data you believe. Pre-seed has come down. And so what I think that reflects is and I know we'll talk about this more, but if you are midstream and you've already raised a pre-seed or seed, it's a much trickier time than if you are a founder coming out, raising your first round of capital, and you have the flexibility of a blank cap table to optimize for this current moment.
Thank you for that, Jen. Sofia, would love to hear your perspective as well.
Yeah, one quick perspective to add more from the sector specific view. I mean, in addition to what Jen talked about, kind of zero interest rate environment and kind of low cost of capital, there was this mentality from growth at all costs from investors. So they were rewarding companies on their growth solely and not kind of fundamentally in other parts of their business models and unit economics. So we saw kind of this rush on pouring a lot of money in different companies, and we saw a ton of companies getting fundraising done in a very short period of time, which I agree with Jen wasn't the normal, and I think we're kind of going back to reality a little bit there, and kind of really focusing on what are the fundamentals of each of those business models, markets that we need to take into account, and really looking at the public market at that first stage where these adjustments have been made. For healthcare and digital health as well, I think we predate the birth of the industry, or a big trigger with kind of back in 2010 with some of the big regulations that happened in our industry, like the Affordable Care Act and the HITECH Act. And we saw that first cohort of companies go public and boom in the COVID era, just given everything that was going on in the healthcare system and the need for leveraging technology to do better care because of COVID. But then we saw kind of a big decline after that, that really follows like a traditional hype cycle, right? But it's a very young industry. We've only really seen one cohort of companies be public. So I'm hopeful that we look at some other industries and see some of those cycles and how they've endured over time, that we're going to have a lot of learnings from other industries like fintech and cloud and internet to also see digital health be successful in the longer term.
Great.
And I think overall, Jen started off exactly where I was on, like, it starts with macro, and where there's just significant capital, the debt. And I think, and as a result, there's a lot of money chasing deals, and the diligence is what's the torrid pace of executing on deals maybe led to less diligence to really evaluate where are these just momentum driven tailwinds versus true resilient business models. And so I think that on that normalization, oftentimes we can end up seeing an overcorrection. And as I think, especially with kind of looming inflation, recession, as well, what that might mean. But I think where it really kind of takes to the climate is that, companies really need to assess the true market dynamics and make sure they have a clear value proposition, understand, that they've been building those strong customer relationships that will sustain, through market downturns. Because I think that, cycles are natural. And we just need to kind of, and when things get irrational, then bubbles will burst. But I think that, we are getting to a little bit more of a normalization. And I think it'll be really important for companies going forward just to keep that keen eye on capital efficiency.
Thank you, guys. So knowing, these changes, can you all speak to how your focus has shifted over the last 12 to 18 months, and what sectors or industries or sort of changing perspectives are getting you guys more excited now in terms of investment?
Yeah, so we had actually really slowed our investment pace at the end of the back half of 21 and beginning of 22, because as I mentioned, we do pre-seed. And at that point, founders were coming out and raising, pre-product, pre-revenue, pre-anything built at really high valuations. And we're sort of skipping what would traditionally be a pre-seed valuation or a pre-seed round. And so when the market reset, that actually made us much more bullish to deploy, because I think we saw, and I think it took a bit of time, but what we've seen is that at the earliest stage, founders' expectations have reset. I think founders, in addition to building in a scrappy way, are being smart about how they think about the initial round of capital to set them up for future success. And one of those key things being, rather than aiming for the maximum valuation at all costs, realizing that they need to have enough headroom for the next round. So all of that makes us really bullish to deploy. I think one of the other things that we've seen reset that is related to the fundraising market is the type of founder that we see in the market has changed. So I think 2 to 5 years ago, really, it was like sexy and cool to be a founder. People were saying like, oh, I'll go raise some money and then sort of be a founder and figure out what I'm going to build. And we spent a lot of time at, on campuses and at, engineering schools and business schools. And like, there's just a lot of like, oh, we're going to go just raise money and then we'll figure it out. And now it's just the complete opposite, right? We're seeing that founders are bootstrapping a lot longer. They're pressure testing their ideas. They know it's going to be so hard and they're doing it anyway. And so that really makes me, as a pre-seed investor, very excited to invest. So in the last quarter, our pace has actually been the highest that it's been ever. So that's exciting. I think some of the areas that we are most excited about right now is we're doing a lot more in climate. And so, as I mentioned, we invest in B2B software. So these aren't sort of consumer climate solutions, but we just see that we've reached a tipping point where enterprise is investing in their climate stack, not because it's like the good thing to do or for the halo effect on the brand, but because it has real bottom line impact. And we're also seeing that top tier founders who have had great success, don't need to start another company, frankly, might not even need to work again, are so motivated by the importance of this market that they're getting in. And so that's a place where we are spending a lot of time right now.
Thanks, Jen. Trina?
Yes. So I've kind of split it into two ways of kind of where our focus has been. The first is just on supporting our existing portfolio companies. And it's an area where we were really looking at, like, are there opportunities for strategic pivots, to align with, market demands, and just really understand, like, back to kind of the roots, core competencies. How do you optimize your cost structure? Make sure to extend your runway. For the new investments, we, with our history, have invested through several downturns, and when we've evaluated, just looking at vintage years, they've been coming out of these downturns have been some of the best ones. And so, because overall, as technology investors during these periods, companies continue to invest in technology, trying to find ways to, again, continue to accelerate their growth. So we're very pro investing, but we remain very disciplined. And for us, it's like thesis first, diligence, price sensitive, and really kind of thinking through the range of returns. A couple areas that excited about is continuing with kind of data analytics and kind of insights driven businesses, and even around climate. I mean, Grow Intelligence is one of my companies, and again, it's just like it's integrating 50,000 data sets and then trying to kind of map that into like driving real decisions that impact bottom lines. And I think we're seeing with kind of the explosion, like AI models, are the multimodal data sets are going to be 15,000 times larger in 5 years, but we can't necessarily compute all of that and manage and store that. So how we can use technology to focus on getting the right insights and to help kind of drive business decisions. And a second key area that I think is really interesting is the convergence of digital and physical worlds. We're already seeing a lot of that in kind of real-time applications, digital twins, and I think even this impacts like industrial worlds, the labor economy, planning, maintenance, like kind of integrating with computer vision. And I think the last area is just even like more like labor economy and worker productivity. And some of that kind of fits in with the convergence of the digital and the physical. But this is even like humanoid robotics is also just like a fascinating way of like how we work along humans, but to help protect like employees from injury, maintain kind of resiliency in supply chains, a couple areas.
I'll weigh in quickly, and I'll caveat that Bessemer is a very large fund and we invest in anything seed to growth, and you'll see like different partners and investors tend to spend their time in particular sectors and different stages. So I'll speak to myself and the healthcare team as well. But like we over the last 3 years, we moved a lot earlier in making earlier investments, just given the valuations and the climate, the frothiness of the later stage market. So we made a ton of seed and Series A investments. And over the last year and a half or so, we've been spending a lot more time later stage. So going back to our bread and butter, which is like Series A and B. And part of that is, the later you are in the process, there's a lot more data that we can really understand what is really fundamental, like resilient business models in healthcare and scalable business models versus momentum driven. I think Trina, I wrote that down because I really, really like when you said that, especially for healthcare, what was really a COVID tailwind versus what's a fundamental shift in the way that we're delivering care. And then the other area that I've been spending a lot more time is, and I think we'll love to get Jen's perspective, just given your fund's thesis, is fundamentally it's really difficult to sell software in healthcare. Like the physicians and health systems and payers are not great at buying software and using software. You look at the number of unicorns and public companies, there are really very few successful large software businesses. It's inherently a vertical SaaS play, and their sales cycles are really long. So we've been seeing some emerging trends that we're spending a lot of time in today with just exciting shifts on AI and ML, and how do you think about delivering services as software with large language models and kind of new companies in the early stages, really thinking about how you're going to attack some of these jobs to be done or use cases that could be automated and enable the existing infrastructure to be digitized. So we're excited about that. And then other areas that we spent a lot of time in, we're very we always have a lens on regulation. I think that regulation in healthcare can create opportunities for digitization. So we're always looking at that as an area where we like think about where are there new opportunities for deploy new technology in the space.
I'll just add, we're seeing, a lot of the same things that you guys are saying at Pari Passu. I think when you have these swings in the market and purse strings tighten, like there's a tremendous amount of opportunity to lean into, right? If you have the capacity to do so. And I think from what we're seeing, while a lot of folks that used to be pre-seed are waiting and sort of spending more at the seed to kind of have clear product market fit, like there's just a tremendous amount of opportunity. And the companies that are less focused on like building hype, right, of the past and much more having a clear path to profitability are the ones that we're really focused on as well. So completely agree on that front. So let's talk about, the IPO market and how much does that play a role in your guys' thinking, right? How do you see the short-term thawing? How does this affect, trading in the private market and how you really think about the ecosystem? Sofia, let's start with you.
Yeah, and this is timely. We actually just released a report called the State of Health Tech report, where we actually looked at that first cohort, as I was saying, of companies that went public on digital health and how they performed. And candidly, it's underwhelming, the performance of the overall cohort. Obviously, we're not public market investors and don't particularly speak about any particular company, but we look at kind of a cohort of 32, both healthcare software and tech-enabled value-based care services as part of that basket to really think about the industry as a whole and like multiples and drivers. It is important for venture capital investors to really look at the public market as kind of the potential of like what the exit can look like for early stage investments, and also for dynamics on how do you value these businesses, what are enduring business models, and then potentially also what are the strategic imperatives that incumbents are looking into in some of the acquisitions that we've seen in the last 24 months for some of these companies. So it's kind of not just trend driven, but also understanding kind of value drivers and valuation multiples as we look at early stage businesses. That being said, there's only one cohort that's gone public on digital health, which we studied in detail. There's also been a ton of private M&A activity in the market, and we see a ton of different incumbents in healthcare be very acquisitive. We've also seen a lot of companies that are not healthcare companies that are looking at healthcare as an imperative for their business. I mean, if it's a $4 trillion business and you're in a company that needs to either provide care or you have a big brick and mortar footprint like Walmart, you're thinking about Best Buy, you're thinking about what role you're going to play in the biggest industry in the world, right? So those companies have also been very acquisitive. So that long-winded way of saying the IPO opportunity is important, but we also think that there's a lot of liquidity and opportunity in the private M&A market.
Jen, Trina, do you have anything to add from your perspective here? Either one.
Yeah, I can just weigh in quickly. I mean, I think I would just underscore Sofia's point for the founders that are listening in, which is like, obviously, I think Sofia, Trina, and I are, and Julia, you as well, like we're all looking for companies that are, and founders that are looking for those outlier, just alpha creating opportunities. But the reality is when you look at those, like some of those happen through IPO, but actually the majority happen through acquisition. And so, but I think the way we think about it in two ways, like we are such early investors that we know our companies are going to go through cycles as they build. And so we are not trying to time our investments to a specific IPO window. And so in that sense, like we almost don't pay attention to it, but there are two ways in which we are paying attention to it. Like one, I think it is impacting the follow-on capital in the market and the valuations that people are willing to pay. And so that's all stuff where we really try to be thoughtful about it from the start, but also help our founders interpret what that shift is like when they're going to go out and raise capital so that their expectations are appropriate. The second thing that we think about is, given how illiquid the market has been, it means that there is a lot less liquidity flowing back to founders, right? Like an IPO event actually creates a lot of wealth for entrepreneurs and early employees. And one of the things that historically those people have done is make angel investments. And without a lot of that liquidity and that flywheel, we have seen sort of not a drying up, because that's a little bit too dramatic, but the angel market is still alive and well, but it's not growing in the same way. And so we see this, there's actually more of this opportunity for what we're doing at pre-seed, because that's often, angels are where a lot of founders turn for that first check. And there isn't as much new angel capital flowing into the market.
Let's switch gears a bit to investing specifically in companies and kind of some of the non-negotiables, right, that you look at. I'm sure we're going to see a lot of differences across the stages and the verticals. Trina, let's start with you.
Sure. Well, from overall, very focused as an investor on three things: looking at the market opportunity and the ability to even create new markets that's coming through with the company. Second is like their key differentiation, and is it significantly better than an incumbent? It can't just be twice as good; it might even be 5 times as good on different factors. And is that kind of business model that they're developing, and that may be the differentiation. How resilient is that? And third is the team, both in kind of execution, the ability to experiment, the way they manage, that they're adaptable, coachable, and you need all three. And any time that we've seen like where you are willing to give in a little bit on one, it may take a couple of years and it shows. So those are really just honestly the fundamentals, and it holds true through all stages. There might be slightly different expectations that you have when you're investing at C to A to B and beyond, of kind of what you need that to be, because a founding team at early stages is not going to have all the capabilities. But again, that they can adapt and pivot and kind of recognize and really kind of building the right people around them.
Completely agree. Sofia, would love to hear your perspective.
I mean, I really agree with all of the things that Trina said, and will really underscore kind of the problem. And I like to always say, like, we're looking for solutions that are solving hair on fire problems. So take who's your customer and how you're going to prove to them you're solving a really important problem for them, and then how you're going to prove that it's adding value to them quickly. Because I think in this environment where buyers are really like limiting where they're spending budgets or kind of simplifying the number of vendors that they work with, you really want to be that top priority, and you're going to prove return on investment for their solution within 12 months. So hyper focus, especially in healthcare, on that ROI, both financial for the buyer, but also clinically as well, in the outcomes that you're providing for your the patient and the customer, which don't always align with the patient, who is the one who pays. And then other things that are very important for healthcare companies as well is just efficient growth, right? And then fundamental strong unit economics and how you're scaling that business, which doesn't always align with your traditional software business model.
The last thing that I would just add, because I agree with everything that Sofia and Trina said, is like the unique wrinkle I think we look for at the early stage is obviously a team that can like really ship product fast and get into like the test and iterate mode. But it's also a founder or founding team that can sell. And that doesn't mean that they have to be a charismatic extrovert, right? It looks different in every founder. But what we have seen in our portfolio is like a founder in the early days, they're selling to prospective employees, they're selling to investors, they're selling to prospective customers. And it's all about this like evangelism, right? Translating the vision that they have to everyone that they're trying to get involved. And that ability to sell and evangelize is what we've seen be able to create momentum. And it needs to be backed up with substance. So where we haven't had success as founders that are just great at the selling piece and don't have the ability to back that up and deliver the product and drive customer outcomes. But a technical founder who can't sell and can't create that momentum also has a different challenge. So that's one of the things we look up for.
I love all those answers. The one that I will add is humility and adaptability. Like if we smell ego, which there's difference from confidence and ego, like, I don't know, we've learned just to run in the opposite direction. I think you learn those lessons with time and with certain founders, especially like having to navigate everything that's happening. But completely agree with everyone else. Are you guys seeing from if you have like institutional LPs, pressure to get back to deploying capital? And any of you can chime in, and then would love to go around. Let's start with Trina.
We have a unique benefit of having a sole LP. So it's not kind of the same type of pressure that maybe other institutional investors, but as a result, we do want to make sure that we are being very supportive of our portfolio companies. We have the ability to be patient, but also to really kind of get engaged to see where can we drive and add extra value. So again, it's a little bit different, but it's a bit for even founders thinking through how they think about building out their cap table with a combination of investors that have maybe different approaches from their LP base.
Yeah, I can quickly chime in as well. We are similar in the sense that we have a big portion of our LP capital that comes from the Bessemer Fund, which is kind of part of the Phipps family fund. Bessemer has been around for 100 years, and we started as a family fund, family office for the Bessemer Trust, and now currently they make still a big portion of our capital. So we also take a really long-term approach and really being thoughtful about deployment pace as well as kind of hold periods for a lot of the companies that we partner with. So we're not really seeing that.
And we do have a more traditional LP structure, but I think we aren't seeing pressure from LPs. I think, frankly, with some of the market turbulence in the last month and a half, like any progress towards some of the progress toward the solving the denominator effect is now, it's back in play. And, I think LPs, there are some LPs like a fund of funds that needs to deploy a certain amount each year, and they may feel differently than an endowment where, they actually need to make sure that they're funding their programs. But I think overall, what LPs seem, at least for us, care more about, rather than are we deploying on pace or not, is like, are we sticking to our strategy? Do they like what we're investing in? Are we making strong investments?
Let's look to, so many people in the audience might be fundraising now for the first time, right, in this landscape. So let's go around, and if you can have sort of key pieces of advice that you'd give the founders in the audience, right, as first time fundraising, would love to get into that. Sofia, do you want to kick us off?
Yeah, and I'll caveat, obviously, I spent a lot less time at the pre-seed, but the first thing that comes to mind is just be kind to yourself, because being a founder, I think, is the hardest job in the world, and I admire all of the founders that I partner with. So really, the added pressure of the existing environment, I think that you need to take a step back and think about just you're embarking in a life, you're trying to change the world with what you're trying to do. And I think that I'm so compassionate about what you're doing. So be kind to yourself and think about, there's going to be a lot of no's. And honestly, it's the hardest part of this job is saying no to things, but perhaps they're not the right stage or don't align with our investment thesis. But there are a lot of people out there that will believe in that vision. So just remind yourself of that when you're going in the process.
I'll say we've talked about a bit in the previous question, but I think two quick things. One is really choose your partner carefully. Like whether it's like value beyond capital, the engagement at the board, there with you through the down times, rolling up their sleeves and helping is very important. And the second thing is that in this type of fundraising environment, there can be a lot of safe notes and convertibles. And it's something that you have to make sure that you're paying attention to the dilution that you may be getting with certain caps, because I have seen some come across with just extending safe notes, and all of a sudden they've given up 60% of the company really early on. And so it's where I think founders have to be making sure they're paying attention to what impact that capital will have on their dilution and that opportunity then going forward.
Yeah, those are really great points by both Sofia and Trina. I think so. A few just on like the process. We've all talked about, we want to know like why the team is building and what they're doing that's differentiated, and why the founders are the right people. And so like a lot of founders will spend a bunch of time on their pitch, which is very important, right? So I'm not trying to say don't do that, but I would say it is equally as important as to run a tight process. This is a sales process. Most founders will talk to double-digit numbers of funds. Some are talking to triple digits, right? Like this is about finding the fit with an investor. And I think it's not only about getting an investor to want to invest in your company. I think diligence is a two-way street. So it's making sure that you really want that investor to be on your cap table. But that takes a tight process to do. And so talk to other founders about what process worked well for them. Talk to advisors, mentors, VCs that maybe aren't going to be a fit for you, but they can weigh in on what process you should run. It's the founders that we have been seen be incredibly successful, particularly in this market, are ones that not only have a great pitch, but run a tight process. And part of the reason that's important is like, as an investor, when I see someone running a tight process, that is also then a proxy for how they are going to run a sales process, how they're going to hire, like how they're going to do everything. And that's, since we aren't looking at historical data, that's a key indicator into, okay, what's our proxy for how this team will operate? And then the last thing that I'll say is, I think sometimes sort of counterintuitive for some founders, which is if you are starting a company and you're going to fundraise, tell everyone about it. I think some founders keep things close to the vest, and it's like, well, what if someone steals my idea? It is so like, just in the way that the first version of your product is probably going to be ugly and like held together with duct tape and string on the back end, like so is your pitch and your fundraise. And so just tell everyone what you're doing, get all the feedback, listen to the feedback that resonates, and allow like the serendipity of the networks in venture to do their work. Because one of the things I've found is we raise money, and we've seen it with our portfolio companies, is like you never know where that lead investor is going to come from. And the more people you tell, the more people are out there trying to connect the dots for you. And I think your network can really work for you in that instance.
I really love that. I just wanted to add one quick thing, because where I sit and I spend a lot more of my time at the A and the B. So perhaps not that first fundraise, but like spend time building relationships with investors that you are value aligned with, especially for like A and B. And I see Trina nodding, is one of the things that happened in 21 where like processes were so short that we weren't even like able to get to know one another. So I personally I really enjoy more this type of investing, where I'm being more proactive about areas that I'm spending time in and like getting to know every company and building relationship with founders. And we've seen the most successful founders run a Series A and B process when we've gotten to know them for several months. We understand their business and nuances and the key questions that we have. But then we can run a really tight diligence process on our end once we get access to the data room and we actually deep dive and get to spend more time on their specific business when they're ready to raise, and sometimes even preempt some of those processes if we get conviction in the space even before then.
So I'll add a few tidbits, things that sort of we've seen, and I've been on the founder side as well. I think if you're a first-time, founder or first-time fundraiser, having great advisors that can help you kind of navigate around the process, both with introductions, but also like really helping refine your pitch and everything else, I think is really meaningful. So I would say, don't be dilution sensitive, to give half a point or even more, right? Depending on like the right strategic folks that can help you navigate. I think it's also really important, you're going to have a lot of rejection, but asking for feedback, right? And sometimes like investors might accidentally ghost you, and it's not because you're terrible, it's because they might be busy. So even following up to close that loop to get that feedback, I think is really important. And just the last piece I would say, I remember before when I was like a founder, you like ideally want introductions from the people who are in first, right? And so you're like, let's focus on getting this person in. But even if someone passes, like they know so many investors, and it's not a bad introduction. So even the investors that pass, to ask them like, do you know anyone that you think might be a good fit, can open so many doors, right? And then sort of onward and upward. So highly recommend adding in those tactics as well. So we've spoken about folks raising for the first time, right? Let's talk about advice that we can give to founders who may be coming back into the market to fundraise for the first time, let's say in the last 2 years, right? So maybe last time they raised it was 2021 when there were peak valuations. What advice, and I'd love to also go around the room, right? What advice can you give to them? Let's start it off with you, Jen.
Yeah, so I'll start with, I think these are the founders that I have the most empathy for, particularly the ones that aren't at the growth phase where like there's just more levers to pull. So I think if someone's coming back for an A or a B or even a C, like it's it's tricky because basically what you've been asked to do is get to 2 to 3x the milestones you thought with the same amount of capital. One of the things, so it's interesting. We just did a fundraising workshop for our portfolio. We do them like periodically. And one of the pieces of advice that came from, we had 3 Series A through C investors. And I'll share their piece of advice because it was really surprising to me and made a ton of sense, which was don't necessarily name your round when you're going out to raise. We are seeing a lot right now of like a seed prime and a Series A extension prime. Like the names are very fungible, but one of the things that I've seen, and Trina and Sofia, you can validate if this is true at your firms or with your peers, but if people may be having trouble getting, let's say, a Series B over the line, but if it's an A extension, they have more flexibility. And so I think what the point behind this is, you don't, as a founder, you're not quite sure how decisions get made in a partnership. And if you can give the partner that you're pitching some flexibility on how they position the deal, that can actually be very effective. So know that like the most important thing here is raising capital from a partner that you really trust. Be flexible on valuation, be flexible about what that round's called, because no one's really going to care. And it's easier said than done, but do focus on that right partner. Don't make just getting capital in the door the reason that you say yes to someone that you don't think is going to be a good partner in 3 years when the market has turned.
I can quickly add to the point I had made on building relationship with investors over time, as well as be even more data driven than you were before. So understanding kind of all the ins and outs of the performance of your company, and then think about figuring out what are the right benchmarks for your business model, and how do you compare to those benchmarks. Like you're not expected to be best in class at every kind of metric. Obviously, it will be a lot easier process to run if that's the case, but that's not necessarily the case in many ways. So really understanding what are the drivers of your business, and like what are leading indicators that you've focused over the last 6 months and improving some of those KPIs that perhaps were not outperforming the benchmarks in the past. I'll give you an example. Like you were very focused on growth at all costs, and now you're focused on more efficiency, so your growth is going to be a lot lower. And like investors don't understand these trade-offs. So really understanding some of those drivers, and then leading indicators that you can point to of those key questions that will come up during fundraise, and how you're focused on improving those with the next round of financing will be very important.
Yeah, and another quick point there is, in addition to the relationships you're building with investors, it's also with other key customers and partners where you're thinking through, and back to like tying it together with maybe IPO markets, when that's going to be open, what might be the exit outcomes, really thinking through your possible exit paths, starting to build the relationships with the potential suitors. I kind of dub this suitor intimacy versus just customer intimacy, because that may be the likely path. And that may also help you in the fundraise, where giving, again, those investment partners like, okay, sure, there's an opportunity for a really big outcome here, but we also see there's half a dozen really solid potential buyers. They have relationships. We don't know where this will play out. And then the last point is, as we're thinking about raising additional capital, is really looking at that liquidation stack and how much is getting built up. Especially if there's becoming a lot of notes that are going to convert with or not convert with high multiples. It's an interesting question for companies and all shareholders. Sometimes exiting earlier can be better for common than getting such a high liquidation stack and you haven't been able to raise enough to get through that next big milestone. So it's really taking a really good inward look on, where do I think this will go over what time frame and what are my outcomes?
One quick other thing to add, because that reminded me of, is obviously valuations of over the last few years and the gap from kind of where or multiples that were before versus today. And that's the reality, right? I feel like a lot of folks are a lot more conscious on that. Understanding really like the trade-offs of taking perhaps a term sheet that has lots of different dirty terms, and it may make it difficult for you to raise another round versus taking a down round, and really thinking about the trade-offs of that, and perhaps like thinking about the incentives also from internal investors as well as your employees and yourself and what's the best path forward. But I tend to be a believer of cleaner terms are going to like make it easier for that next round of capital, even if it means taking a down run today versus taking some of those terms that make it more difficult for the long-term viability of the business.
Sophia, I was exactly going to say the same thing. I mean, we've seen companies that, to avoid a down round, add warrants and advisory shares and all these bells whistles, and like a down round is okay. It's okay as long as you're showing that like you're, focus on fundamentals, and like it'll spook some investors that just want the hype. But at the end of the day, like the people that are trying to make money will back you on the down round. I think just one other piece to add that I've seen is some founders that we've passed on previous rounds have created like newsletters where, on the data side, which Sophia, you said is super important, like they're sharing updates, right, to even folks that have passed. And like, we're investing in one of those companies now. So to be proactive, to create those email lists and keep people updated, a lot of the times investment does come out of that. Let's switch gears. This is probably the last couple of questions as we're wrapping up. But this year, obviously it's obvious. AI has been a major trend, right, in the venture ecosystem, right? Some folks have joked that, if you put AI into your deck, right, you greatly increase your chances of actually getting funded. How are you all looking at the trend of AI? How are you thinking about implementing the tech into your thesis and your due diligence and companies that you're looking at? Let's start with Trina.
So we've been investors in AI for actually a long time and have been through some multiple hype cycles and through the show me stage. So just to quickly address don't put it in your deck unless you're actually really using it and can point to the value proposition of how it is taking your business forward. But we're we're very thesis driven versus momentum. And with it, how we're thinking about it too is on kind of this like where some things may be getting overhyped or valuations just seem too frothy in some areas. We very much focus on when you get in and at what valuation is important. So there may be situations that we decide we'll go earlier on this one because we're getting in at a 25 million pre, and we can see some great opportunities for multiple hundreds of millions. Maybe there's $1 billion outcome, but that's still great. But now getting into a similar company that just has raised a bunch of capital but hasn't really executed as far, and now they're sitting at a 500 million pre. I think we're going to be very, very price sensitive. And then how we take that approach is just on diligence, is really thinking through what is a key value prop. I think Sophia had mentioned this before as well on, are you solving a real customer problem, that is going to be tied to budgets that they're willing to continue to fund versus it's this new, exciting, sexy thing that's going to disappear once a new leader of that business group comes in at a large company.
I can add to that. Oh man, please don't just say you do AI if you're not, because, investors are going to look at your team and understand the capabilities and the experience of the team members that you brought in. And while there is a huge technological and improvement in the way that we can use AI today and large language models and the use cases that it can be used for, and there's a lot of excitement around that, we are very focused on understanding, one, what's the technical on the go-to-market team that you put together that will enable you to succeed at that vision, and then two, really understanding the use case that you're trying to solve. And if it's just added AI while you're doing something completely different, like your care delivery company, it is really irrelevant, right? Like the problem that you're solving, you need to use the right tools in the toolkit to address that problem and provide the best solution for that.
Yeah, and the last thing I'll add real quick is like, while I agree, you don't want to put that you're an AI-focused company if you're not. One of the things that's been really interesting is to see how AI is changing company building, even if the company is not focused on AI. One of the things we're interested in is like, how are you leveraging other AI tools, or what are you building to help with your own operations and like help you be more efficient and cost effective and go to market quickly or increase your product development cycles. And so I think what is interesting, even if a company is not AI focused, it's interesting to see how companies founders are leveraging AI to almost in a way that cloud computing just changed the way that companies were launched. We're seeing some interesting threads around how that's changing. I think it's too early to tell, but that will be really, I think, fascinating for all of us on the investment side to watch over the next few years.
Right. I think this might be the last question, given timing. But what of the trends that you guys are seeing now do you anticipate sticking, and which do you expect are just overhyped currently? Would love some quick answers here.
I'm happy to start with two. The first is I think we all mentioned it, sort of the fact that founders are building with fundamentals in mind. And that, I think, is a good thing. I hope it's something that sticks around. I hope we don't immediately, whiplash back to building for the sake of raising capital. But I think that plus all of the trend towards taking the time for diligence is really healthy. One of the things that we've seen in the past 18 months is that in a risk-off environment, investors are retreating to their networks, which means that they're backing founders that they know, repeat founders. And I think that trend, I think we are at risk of erasing the modest, but real gains that venture has worked on in the last 5 to 10 years to expand the set of founders that are funded, get funding to founders who are outside of the traditional venture networks. And I think there's a risk that a lot of that progress gets erased, and that's something that I hope begins to change, and that investors realize what we're all looking for are the founders that are going to create outlier returns. And that often means finding outlier founders who don't just match the typical founder pattern.
I'll take the other side of the coin there and hope that with more of an emphasis on kind of metrics and kind of proof points on how your business is scaling, at least past the early stage and more of the A and the B, that we're going to see a bunch of focus not on hype, but more on how those fundamental companies are growing and the problems that they're solving, with clear signs of customers really willing to pay for the solutions that you're focused on. So I think everyone says in this type of cycles and kind of downturns, the best companies are built, and it's because you're kind of forging something out of very little to build from. So you're very focused on how you're spending capital, the return on that every dollar that you invest in your company, and how is it going to convert into a well-oiled machine, right? You have all these little knobs that you're playing with. So I'm very excited to really see the next cohort of companies that are built in this cycle.
Yeah, agree with all of them. And the only thing I can add is that hopefully the ability to just remain scrappy and just keep being creative, experimenting, regardless of hey, well, this is working, but how can we do it better? That hopefully that just becomes a core value in the way, founders operate.
Great. Thank you guys so much, Trina, Jen, Sofia. And thank you for everyone who's listening. I hope you got some value out of this session, and the Startup Grind Day, I think, continues.